All right. Good afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative here with the last week in mortgage today, our weekly whirlwind through all things mortgage industry. Each week, I'm lucky to be joined by one of our lender members as my co-host. And this week, very happy to once again be joined by the SVP Director of Mortgage for Right By You Mortgage, Melissa Langdale. Melissa, thanks for co-piloting once again with me.
Yeah, thanks for having me, Rich.
Awesome. And if you could just start out by maybe just telling the listeners a little bit about your organization, Right By You Mortgage, a division of Fidelity Bank out of North Carolina. Would love to hear just how 2020 ended up for you. Anything in particular you've got, strategically in your vision for 2021. And just tell us a little bit about your operation.
Yeah. So Right By You Mortgage is, as Rich mentioned, a division of Fidelity Bank. Fidelity is just shy of about a $3 billion bank, and we have over 50 branches across North Carolina and Virginia. We, on the mortgage side, even though our Fidelity Bank is 111 years old, on the mortgage side, we have been operating as a full lender for about 2.5 years now. So we're fairly new in the mortgage space. We did $260 million last year. But that was 120% growth year over year. So it was a very good year for us in 2020, and anticipate having another really strong year in 2021 as well. Like I said, we're mostly in North Carolina, and we are just in North Carolina and Virginia. And I don't know, that's about it. That's all I got to share.
Want to just remind everybody, any questions, comments, anything as we kind of go through the program today, just feel free to either unmute your mic or pump any questions or comments into the chat or Q&A, and we will voice them aloud. So Melissa, before joining Fidelity Bank 2.5 years ago, good timing by them on starting the mortgage division. It was a very bad period of time for the mortgage industry. It's gotten better, but
we took advantage of it. We got some really good talent.
That's awesome. You came from the IMB world, though, and I'm always fascinated. Our organization obviously is made up of depository institutions, independent mortgage banking institutions. Always just interesting to me, talking to leaders on both sides of that equation. Any just, observations you have, the IMB world versus the kind of depository world, some things that have resonated with you since taking this role 2.5 years ago?
So yeah, my entire career was in the IMB world. This is the first bank that I've worked for. I love it. It's an amazing bank. Our world definitely is different, the IMB world, but we built our division very similar to an IMB. So we sell 100% of loans I take that back. We did launch portfolio this year, so not quite 100%, but we do sell a lot of our loans. But the great thing about working in a bank environment, particularly in the last year, has been we've been able to develop portfolio products. We've been able to hold loans in-house. As the jumbo market kind of saw its big swing, we were able to kind of take advantage of that and grow our portfolio. And so it has come with some advantages in the last couple of years that have been, I think, differentiators for us in the market.
Very cool. Excellent. Thanks for going through that for us. And let's get into the news headlines here. A couple items of note that broke in the news the last couple of days. Let's start with Janet Yellen, the first female head of Treasury. At least from everything I'm reading and everybody I've talked to, seems to be a universally welcomed appointment. Any thoughts on Janet Yellen and becoming the next Secretary of the U.S. Treasury?
She's pretty amazing, right? I mean, from a person standpoint, I think she's amazing. Being appointed the first female Fed chair, and then now the first female Treasury Secretary. I think there's a lot of really cool things about Janet Yellen. I do also like the fact that we can take a look at her history as the Fed chair to kind of see what we can expect of her in this new role. And, one of the things that I think our industry enjoyed is her transparency. She was, if change was coming, she was going to let people know about it ahead of time. And And I think we're going to see that in her new role too. And I think that's going to help, us not to see some drastic market changes. I think, she's pretty much announced her focus out of the gate to be really along the lines of trying to control, I guess, the economic impact of the pandemic. And, she's talked about doing another stimulus round that could help aid in vaccination, distribution. And so, all those things are very necessary and needed for us to be able to get past the recovery. I think one key thing that she said in her confirmation hearing was that she really didn't want to take the foot off the gas pedal before the recovery fully took hold. And, it'll be interesting to see her navigate that and know when the right moment to take the foot off the gas pedal, so to speak, is. But I'm excited about this personally, and I think she offers some good things for our industry and for the markets in general.
Certainly uncertain times for the U.S. economy. Obviously, dealing with the pandemic and rounds of stimulus. I think that the financial markets felt good about disappointment. Key leaders in our industry and just, all industries that kind of dabble into finance universally kind of liked and welcomed the appointment. The thing I like about it personally is having a head of Treasury that has been the previous head of the Federal Reserve. Those two organizations obviously working very closely, hand in hand. As you said, very transparent, great experience. Seems like about the perfect person to hopefully help lead the U.S. economy out of what has been a really weird year.
Yeah, I completely agree. I love the fact that she's very data driven too. Most of the decisions she made as the Fed chair, you could count on her to be very data driven. So I think, that is one thing we can count on going forward in her decision making and how she's going to help us to navigate, the just economic environment that this pandemic has created.
Absolutely. So moving on, another report this week, Zillow came out with their housing forecast for 2021, at least the most updated version of it. Really turned some heads, predicting a 21% year-over-year increase in existing home sales. Now you could argue that, hey, it kind of behooves their business model to make aggressive predictions, but this is certainly more bullish than we've seen from a lot of the other major economists. I think existing home sales from 2019 to 2020 were up about 5%. Depending on who you're looking at, you were seeing projected increases between like 10 and 18%. But Zillow really, really bullish on home sales here in 2021. From your seat, running a mortgage banking operation, how are you looking at 2021, just as it relates to home sales? And what did you think about the Zillow report?
Well, I think there's a couple of things that can impact this number. Obviously, a lot of our markets are challenged with inventory shortage right now, and that's going to continue to be a challenge, especially with rates so low. You may see just more people kind of hold back on selling and just try to rent it out. Those financially stable and strong homeowners may choose to just keep their home and let the home appreciate, because obviously the increase in demand and the decrease in inventory is going to cause a ton of appreciation in the area. And so you may see some people just kind of hold on to that home instead of selling it, which again would just exacerbate that challenge. So there's that, but there also is a layer of they've cited some data that would suggest that they're suggesting this higher number because 2020 really didn't deliver, that there's really this increased demand between 2020 and 2021 because that spring home buying season that we would have traditionally seen just wasn't there, and job insecurity or people not being comfortable with people being in their homes, all those things kind of affected the housing market in 2020, where, with the vaccination coming out and kind of a new administration, I think there's layers that they're kind of betting might help the housing economy. And one, from a new administration standpoint, Biden has talked about, tackling housing affordability. He's mentioned in his policies about maybe looking at some sort of stimulus, down payment assistance, tax credit, kind of thing. And if that happens, it might actually, either get people off the fence or kind of artificially inflate our economy for a little bit, our market for a little bit. So those things could bring us, that far, but it is definitely an aggressive statement. I think we'd all love that. Most of the predictions on the refinance fall have come, between 20 to 40%. So that just means all of us would have a very steady year every year. And I think, again, we'd all love that. We are actually at Fidelity Bank, Right By You Mortgage, are actually predicting a very similar year as we had last year. For a lot of reasons. Our markets that we're in are very strong. I think we are also challenged from an inventory standpoint. We do have a lot of new construction in our marketplace. And so, just in general, I think we're going to be fairly steady year over year from our standpoint. But I don't know, it's hard to predict. There's a lot of different well-versed economists that are trying to figure out what's going to happen in 2021, and they're very different in predictions and projections. So it'll be interesting to see what it comes out with.
This is a very, very hard industry to predict. I mean, it seems like all the economists' projections are always right around the same. MBA, Fannie, Freddie, CoreLogic, a couple other major ones that you always see publishing. They all always seem to be just about the same, and then what ends up happening never matches any of them. So, but and new construction, I want to circle back with you on that in a moment here. But I am with Melissa Langdale, the Senior VP, Director of Mortgage for Right By You Mortgage, a division of Fidelity Bank out of North Carolina, with the Last Week in Mortgage today. And Melissa, I think the Zillow report, your comments in general, they back a theme that we've been talking about on this show that has just come up every time I've talked to one of our members, that the budding feeling is that 2021 going to be a better year for the mortgage industry than, again, most are projecting. If you look at the overall projections for mortgage volume for 2021, roughly the average, people are saying down 22%, refis, cut probably close to in half is what most people are projecting. Existing home sales, purchases, things like that. We talked about the variance there. You just said something that I've been hearing from the majority of our members, that you're projecting a year very, very similar in 2021 versus 2020. Is that based on adding people, or is that just based on what I just kind of said? You're feeling that the market's going to be better than people think?
A little bit of both. We have been adding on mortgage loan officers in our world, so our sales team has definitely increased. We also, I think, have some tools that'll help us in the coming year, just differentiate ourselves in the market. But at the same time, I think the market, most of the predictions and projections, the biggest variance has happened in Q3, Q4, where they just, I feel like most of them, there's a small variance in Q1, Q2, and then Q3, Q4, they're like all over the map. It's 40, 50% decline in refis. And, it's, in our world, I just don't know that I agree with it. I think pipelines are so full right now that it's going to take, 60 to 90 days to even get through some of the refis, even when rates eventually go up. And just because rates go up, frankly, doesn't mean that refinances are going away. People are decreasing terms right now. There's also individuals that are always going to need cash out for renovations or, all of those things. And so I really don't know that, we have this exorbitant fear of refinances going away. But there will be a critical mass, right, that just goes through the process, that the opportunity for them to just save money in a regular rate term refinance will go down. But I'm just not predicting that it's going to be as hefty in our world as the 50% decline that we've seen in predictions.
You're right. And I think you touched on a couple of things there that, you're hearing people that feel like this year is going to be better than most think are saying. Cash out refinances for home renovations. People that maybe want to sell their home but didn't in 2020 just because of the weirdness of the year and not wanting to deal with it in a pandemic year. People like I've talked about in this show, I've been kind of looking to buy a house for the last 6-7 months, and I just didn't last year because it was the weirdness of the year and, the uncertainty of everything. So then you really didn't have a traditional like spring buying season. Obviously, you had good purchase activity in the summer and fall months. But, as we said at the outset, existing home sales were only up 5% year over year from 19 to 20. So it feels like there's some suppressed demand in the mortgage marketplace on the purchase side, that refis might not fall off as badly as we're expecting. And could be another really, really great year for mortgage lenders.
I think so.
Yeah, absolutely.
By the way, Rich, I think I know at least 1 or 2 lenders that might be able to help you out with your new home purchase.
I better not have you right. I have a profitable mortgage loan, right? Exactly. So with Melissa Langdale, the Senior VP, Director of Mortgage for Right By You Mortgage, Division of Fidelity Bank out of the state of North Carolina. North Carolina market's got to be popping, right? It always is.
It always is. Yeah, we have, I feel like the need to knock on wood after that one, but we do. We've had traditionally a very strong market. We've not seen some of the drastic, increases in appreciation, but we also haven't seen the drastic declines on the other end as well. We just are kind of steady Eddie, which, helps us. So yeah, it's been a great market. It is a great market.
Moving on to just kind of the general current business climate, good start to the year. I think we saw rates tick up a couple weeks ago after we kind of got on the other side of the new year. And then now they've fallen again. How have you seen any like new application patterns here in January that really differed from your expectations?
We have, I mean, obviously, in a traditional refinance market, it's very rate driven. So as rates go down, you get this influx of additional volume. And so we definitely have seen that over the last, week or so. Our apps really are very similar to what we saw in Q3, Q4 of 2020. So they're very strong right now. So we're continuing to see, not really a decline in apps.
And then what about just the general like hiring and, training and recruiting? Like, has that calmed down a little bit as we've gotten into the new year? In our world, I think it's calmed down a little bit. I think, we're going to see a shift of that in 2021. I think, it's going to shift from the operations recruiting efforts that we saw in 2020 as people were trying to kind of right size the pipeline to more sales focused in 2021 as, lenders are trying to grasp those purchase focused MLOs. So I think we're going to see a little bit of shift in it coming in the coming year, but it's at least, evened out over the last month or so on the operations side. Comment in the chat from my friend Mark Renault from First State Bank out of Michigan. He says, don't forget all the COVID divorces because people are spending too much time together. So 2 loans for 1. So we may know a couple people in that camp, but don't underestimate that as kind of the sleeper cell of hidden mortgage volume in 2021, Mark. So
I actually knew an MLO a few years ago that a big part of his business model was helping divorce attorneys. So there you go.
I'm sure we're going to see like some funny, like after the fact trends from the pandemic, stuff that's not being reported on now. births are down, which actually surprises me. I thought there'd be more births, but births
It's
are
only
way.
because pregnancies are up. They just haven't made it to the birth yet.
Oh, too
I
funny.
think it's coming.
Any questions, comments anybody has for Melissa or I, feel free to drop them in the chat or the Q&A, and we'll be happy to voice them aloud. Got about 7-8 minutes left here, Melissa. The one topic I wanted to touch on with you for sure, though, is new construction. It's a topic we've talked about on this show for the last few weeks. Certainly, we have an inventory issue in America. And, I mean, the obvious fix to an inventory issue, right? Build new houses. Not quite that simple, though. There's a lot of headwinds kind of in the face of the new construction market as we head into 2021.
Yeah, there is. Obviously, as you mentioned, that would be our natural solution to inventory shortage. The challenge is undeveloped land. So builders out there are getting undeveloped land to kind of help with that, help with finding places to build for people. And when that happens, there's a 2-year time period between when they buy the land and when it's actually able to be built on. So you've got this really long process on the front end of just getting developed lots out to the community. But in addition to that, builders have challenges with local permitting processes and increased construction costs. Now, we talked about kind of Biden's housing policies. One thing that's driving those construction costs is lumber tariffs, right? So if that was something that he reversed, that could help potentially home builders be able to deliver a little bit more of an affordable product. But you've got construction costs that are a challenge. You've got a labor force that is a challenge. As 2008 hit, a lot of the construction labor force got out of the industry. And so it's been steadily kind of rebuilding, but there's a significant labor shortage that our construction or our builders are facing right now. So there's just layers that are challenged. There's, impact fees, there's permitting challenges. A lot of our local municipalities have not kind of staffed up for, the need to get through things faster or the, kind of future projected need in the marketplace. And so your permitting times may be longer than normal as a result. And so it's timing. It's getting through not only just the construction of the home, but developing those lots. And then, when you add into that the layer of local infrastructure that's needed to develop new homes, right? You've got, water supply, you've got sewer, you've got road infrastructure, you've got all those things that it takes to really put a whole new subdivision on the ground. And, when you've got, like I said earlier, the local municipalities that are already kind of at their staffing limit, it takes longer to get through those things as well. So it'll be an interesting, probably 2 years for the building community. I think a lot of builders would love to build more homes. It's just getting through some of these challenges that are in front of them that'll determine how our markets are able to respond to the shortage in inventory.
Excellent insight there, Melissa. And yeah, I agree with you wholeheartedly on all the points there. And it'll be interesting to see how it plays out. We've reached out to some people at the National Association of Home Builders. Topic we just want to kind of stay on through programs like this, try to help keep our fingers on the pulse of the new construction market as we head into the bulk of 2021 here. And had a great question come in the chat from Amy Azarandia from First Trust, TMC member out of the Philly, PA area. It says, hey, Melissa, you talked about a new tool you'll be rolling out soon, a game changer. How have you balanced implementation and training of new tools in today's market where pipelines are huge and staff is already stretched thin? Melissa, this is a dilemma. Just when talking to business owners, I hear more than anything. What say you to that question?
The challenge of implementation is, we're not alone. Everybody is seeing the exact same challenge. We are leveraging external resources to give our team additional capacity. We've because we do have boots on the ground in so many of our branches, we've been able to leverage some of our branch associates to help us increase capacity in some of our operations team. We've also created a partnership so that we can outsource some non-customer facing parts of our process too. So we've managed capacity a little different in 2020 as a result. But going into what 2021 looks like for us and how we get across these projects, it really is just giving space to our leadership team. And so we've, we're going to be working on leadership kind of development all year to help our leaders find more time to be intentional with how they impact their teams and how they're able to help us to navigate all of these things that we need to do as an industry. I mean, a lot of companies are looking at technology initiatives this coming year, and most of them are like us, kind of scratching our head of how are we going to do it? But it really is just a matter of capacity. And the more I think we can feed into our teams with extra resources that helps them to stay at highest and best use, the more likely we are to be able to tackle some of those things that can be long-term impactful to our businesses.
Got a couple minutes left with Melissa Langdale here on the last week in Mortgage Today. If anybody has any final questions or comments for Melissa or I, please feel free to drop them in the chat or the Q&A. Melissa, you touched on something there that also, it's been just a personal hot button of mine for our industry and with our members as well, leadership development. Not a ton of industry things that exist that are really kind of designed around developing leaders within your organization. Certainly the all remote or mostly remote thing makes it tougher. As the head of the division, how have you balanced leadership development with not having people in person? Because it makes it tougher, right?
It does. Earlier this year, we all kind of shared our operations and sales leadership team kind of shared our word of the year. What's our one thing that we're focusing on? And my word is intentional. And I think that that plays to your question, Rich. I think when we're intentional about how we spend our time, when we're intentional about how we approach meetings, when we're intentional about how we communicate to our team and develop our team, that's when we see a different level of growth. And so we are taking the kind of approach of feeding our leadership team, just, helping them to connect better together and feeding them kind of business books and, those things that can help us to grow together and to think through things differently, because our industry is changing and we need that. The more, creative brains around the table we can have, the better we are to, the better equipped we are to pivot as our market and our division and companies need us to.
Absolutely. Melissa, excellent insight as always. Always really enjoy talking about the business with you. And thank you for joining me again this week.
Thank you for having me.
And for all our listeners / viewers, thanks for taking the time out. Every week, same place, same time, 2 p.m. Eastern, live for the last week in Mortgage Today. As always, we'll be posting this to our podcast channels and our YouTube channel, so you can listen to it or watch it there as well. But thank you and have a great afternoon, everyone. Take care.